Hi there, Casey Healey, Director here at Central 21, Novocastrian in Newcastle. Back with Nick Ball from Inovayt Finance. Welcome, Nick.
Thanks for having me again, Casey.
Thanks for coming in. We're here with our finance update on what's happening in March. So, you speeding by?
Yeah, it's quite crazy to think that we're pretty much halfway through March.
Almost first quarter down. Look at it that way, wow.
Yeah, so it's been a crazy first 2.5 months to the year. Obviously, we've seen a lot going on in the world and also in Australia with the floods and the rest of that stuff, which is really sad and wreaking a lot of havoc across the East Coast in particular. And then obviously more globally, we've seen a lot of unrest and war and all the rest of it. So
bit of a crazy world we live in at the moment, isn't it?
It's hard to keep up with. Everything is volatile.
It's like you want to close your ears and close your eyes and just go into a little bunker for a little bit.
Yeah, it's almost like COVID lockdown seemed easier at the moment, but yeah, it's one thing after the other. But in reality, things are still pounding forward. Property market's still really strong.
It is.
Interest rates, yes, fixed interest rates have started to move, but variable is staying low at the moment. The noise out of the Reserve Bank is minimal right now. I think they've got eyes on Ukraine, they've got eyes on inflation, wages growth, all that sort of stuff, but we're definitely seeing a lot of change in the actual Australian economy, I would say.
Yeah, kind of 12, 18 months time, I think.
Yeah, look, the fixed rates are a marker for where the banks expect our rates to go, and we're definitely seeing most fixed rates head either closer to 3 or in the 3s, depending on the term. So yeah, we're definitely, later towards the end of this year when we maybe reach some normalisation, we'll start to hear what's actually going to happen, I think, from the Reserve Bank, and yeah, we'll start to see some changes in that space.
Yeah. Let's talk LVR.
Absolutely.
LVR means?
Loan to valuation ratio. So essentially, loan divided by valuation. And what that is, it's a bank. I guess it's pretty much bank jargon, it's a bank calculation. The LVR sets a few things. So 80% is probably what most people have heard of, or 20% deposit, same. That's the line in the sand at which point, if you're borrowing up to 80% of what a property's worth, then you don't need to pay lender's mortgage insurance. And if you're borrowing above that, then obviously you're going to be paying lender's mortgage insurance. But there's a few other things that people don't realise that LVR does play a part in. One of the key ones is interest rate. So banks price loans based on risk. They never used to. Back in the day, everything was the same price regardless, but now things are priced based on risk due to the regulations. So if you're borrowing 60% LVR, you're going to get a better rate generally than someone at 80%. If you're borrowing at 80%, you're going to get better than someone borrowing at 90%. So it's something people need to take into consideration a lot, and it's something worth looking at when you're looking at reviewing your loans or getting a new loan.
Yeah, especially in that review process, because if you've got that low risk loan, then you've got
more options, and low risk is the key point there, because the third thing that LVR plays a part in is policy. So obviously, if you're borrowing 90% of what the property's worth, you're potentially going to be flagged as higher risk than someone borrowing 60%. So different policies are going to apply to you. That could mean different debt to income ratios that we've discussed in the past, different income policies. They won't use so much of this or
so much of the rental income, or
there's all those potentials out there depending on the bank that the LVR does drive policy, which is fair enough when you think about it, because that's the risk that they've got. If you're low risk, they're more willing to lend you money easier generally, because you're in a better spot.
And you can shop around a little bit more and have a little bit more choice.
Absolutely, low LVR, and in this market, given what's happened in the last 2 years, a lot of people that haven't done anything for 2 to 3 years are now more than likely low LVR clients.
So there you go. Always review your mortgage and just understand these types of things and how they can play a part in what you're looking at purchasing. So you may look at something that's a little bit cheaper because that'll give you a lower risk mortgage, which gives you a lower interest rate and less terms and conditions along the way.
Yeah, absolutely.
All right, that's us for this week. If you have any questions in relation to your mortgage, you're looking at purchasing, you want to refinance, you've got an investment loan, please reach out to Nick Ball. He is our broker partner here with Central 21 in Newcastle. I can vouch for his service. He's refinanced my home and helped us along the way with an investment property. So really love the work Nick and his team do at Inovayt. But that's all from us this week. If we can help you in any way, please don't hesitate to reach out. Thanks for joining us, Nick. We'll talk next month.
Thank you.
Thanks.